Are you looking for a place where you can get the information you need to build that path to prosperity? Well, you come to the right place. Welcome to the Master of Money. Tonight's show, we're going to be talking about inflation and deflation, often used by the gold bugs to sell that gold bar to you, but often used to just scare you into making the wrong decisions. So stay tuned for this edition of the Master of Money as we explode the myth of inflation and deflation. This Master of Money program is sponsored by Harvest Investment Services, a registered investment advisor where they harvest gains and minimize losses. Visit them at harvestinvestmentservices.com. And by Superstock Investor, empowering individual investors with institutional research, superstockinvestor.com. And by the participation of the Society to Advance Financial Education, empowering all people with the knowledge they need to prosper. This Master of Money was produced Wednesday, August 12, 2015, and is covering the topics of inflation and deflation, exploding the myths. Welcome back, everyone, to the Master of Money program. I'm Steve Beaman, your host, and as always, it is my pleasure to share this half hour of insight and information with you. Now, you'll notice tonight we've mixed up the Master of Money a little bit. My team and I have worked diligently the last 4 weeks to make this show more important for you, more practical, and more informative. You know, you and I live in a world of the bright, shiny object in the news, and oftentimes our focus is taken off of the rubber meets the road, or where the rubber meets the road, I should say. And so the program now is structured more to give you that impactful information that you need to build a better journey on your path to prosperity. In addition, we're now going to be featuring a cameo appearance by our colleague Jeff Garbaz from Quantitative Partners, as Jeff gives us the market crash indicator. This is an implementable portfolio that you can use as you look with what to do with your capital. This is a portfolio with a very strong track record, a lot of risk control, which you've heard me preach about for months and months and months. And the market crash indicator will come to you in that middle segment of the show. And then when we come back, we're going to go down education. And tonight, we're going to be exploding the myths of inflation. I hear time and time again how people threaten you and scare you into buying gold because they say inflation is on the horizon. Are we going to see $1 million loaf of bread? Well, I don't think so. So when we come back after the market crash indicator segment, we're going to touch on inflation and deflation. But as we get started tonight, let's start right off with finding out in the news where the rubber really meets the road. What was the most important news last week? What news actually meets the rubber meets the road standard? Well, certainly last week there was an awful lot of news, from the Iranian deal to other things, but as we looked at it, we had to decide that the most impactful news last week was clearly the Republican debates that took place. Facebook and Fox teamed up to bring you all 15 candidates who were frankly given just a soundbite to answer some of the most important questions our nation faces. Well, as we looked at it, we thought clearly the biggest loser in the program was, well, Fox News itself. A lot of criticism came out at Fox for the way the questions were asked, the amount of time taken to ask the questions, and the limited response time given to the candidates. Not to mention that, well, one of the Fox broadcasters was actually in a bit of a spitting match with the Donald. That's right, Donald Trump. Well, we'll see how those candidates progress. But as we looked at that and we thought, well, what really matters to people here? What is that one soundbite that might actually make a difference? Well, as we reviewed the tapes, we had to make the decision that really the rubber met the road in the very first part of the show when the Fox News people asked which of the Republican candidates might not support the other candidates if they didn't get the nomination. Well, Donald Trump raised his hand, meaning that if he doesn't get to play in the sandbox, he's going to go home. Well, how many of you remember Ross Perot in 1992? He did the same thing, which guaranteed the Bill Clinton election. And if Donald Trump walks away from the Republican Party, well, you can say hello to President Hillary Clinton. She won't even need a campaign to win that. It would split the Republicans right down the middle, and we think that is the takeaway moment from the debates. We'll have to see how it progresses. It certainly does make good theater for you and for me. Now, as so often is the case, we watch these things looking for policy positions because when the rubber meets the road for you, it matters what you do with your money, how you accumulate it, how you invest it, how you protect it. Well, most of the political spin going on right now does nothing to affect you. We don't think the rubber meets the road at all. So we wanted to give just a quick shout out to that debate because, well, it did get all over the place and there was an awful lot of feedback about it. But I want to start getting down to where the rubber does meet the road. And let's start with the geopolitical, as we always do. Think about this, if you will, as the 30,000-foot view of what's going on around the world. And the reason it's so important to you, as our world shrinks, the economies are much more tied together. And if you aren't aware of what's going on in China and Russia and South America, well, your portfolio can suffer from that. And as the master of money is all about building you a better journey on your road to prosperity, we want to take this beginning 30,000-foot view and make sure you know what's critical. Looking at the geopolitical issues last week, I want to start with Russia. We talk about Russia a lot, but just last week it was confirmed that Russia had engaged in a massive cyber attack against the United States, actually stealing the emails from some of our top military websites. Now, nothing classified was stolen, but this highlights a big issue. China recently was accused and proven that they were doing the same thing to us, breaking into our defense systems, doing cyber terror and cyber war against the United States. Now, you can rest assured we do the same thing to them. But it is an indication that warfare has changed. Information is the driver now. And with Mr. Putin in a free fall in Russia because of oil prices, well, he's going to do anything he can to sustain his power. We need to be wary of the Russians. As we've talked about for a year here on the Master of Money, they're a very unstable enterprise. And as oil prices continue to decline, we can look for Mr. Putin to create all types of instability throughout the world. In fact, tying him in, last week we talked about what they're referring to as the Iran deal. I like to elevate it and talk about it as an agreement rather than a deal. I mean, after all, we're not playing Monopoly. We're actually after geopolitical realities here. The Iranian agreement on one side is supposedly keeping the Iranians from securing a nuclear weapon for at least 10 years. It did that by reducing the number of centrifuges they have down to around 6,000, and then also setting up a regime of inspections that can take place. Well, the arguments against it coming out of Israel and many in the U.S. Congress are simply that 6,000 centrifuges is plenty to build a nuclear weapon. Pakistan did it with only 3,000. And when it comes to the inspections, well, we have to give the Iranians 24 days notice before we inspect one of their nuclear sites. Well, you and I both know in 24 days, you can move a lot of things around. So there's a lot of concern about this Iranian agreement. We'll have to see how it plays out, but I will tell you it hasn't started very well. Just as we were talking about our Russian friends doing cyber terror and warfare against the United States, just this last week, they also had their warships sailing toward Iran. This in direct contravention to the established protocols on Iran. And so we're a little concerned that they're already flaunting their newfound freedom and having taken the restrictions that the United Nations had put on them and taking those off. Well, we're freeing up about $150 billion for the Iranians to use however they want. Well, that's not necessarily a good thing, and we will certainly be keeping an eye on Iran as instability seems to be in the Mideast future. Finally, I was originally going to talk to you just about South America and how throughout South America they're increasing trade relations with China. I think it's interesting. China is a worthy superpower, and they certainly are a good competitor to the United States. Well, over the last years, they've begun to greatly expand their moves into South America. And it tied in just today to the Chinese central bank announcing it was going to devalue the yuan, or the Chinese currency. By devaluing that currency, it makes Chinese exports cheaper and makes imports to China more expensive. We're going to talk about that a little more in our second segment on inflation, but it's important to note that the Chinese are doing everything they can to secure global trade for China in contravention of U.S. trade with other countries. We want to keep an eye on that because obviously the Chinese economy is a driver behind a lot of companies' earnings, and those companies are what you hold in your 401k, your IRA, and maybe your own individual portfolio. We want to be very, very cognizant. Now, as we come down, and again, if we think about the geopolitical as a 30,000-foot view, let's come down to the 20,000-foot view and look at the economic activity last week. Three things I want to highlight. First, the new July jobs report came out, and the United States created about 215,000 non-farm payroll jobs. That's not a bad number. But as we've seen throughout the last year, this number is volatile, and it goes up and down virtually every month. What we'd like to see is stably 250,000 or more each month being created. So 215, it's not a bad number, but it's nothing to drive any optimism. In fact, we could see in the markets, which we'll talk about in a minute, they didn't react too positively to those numbers at all. Secondly, I want to talk about the Fed, and you and I have talked about the Federal Reserve and their impending rate hikes at length. In fact, if you've been a frequent viewer of the program, you saw where we had Doug Roberts on the show. And Doug talked about the likelihood that the Fed would take very, very small increases to the interest rates this year. Well, the Fed has certainly seemed to be saying that, and we are now looking for the Federal Reserve to raise rates in September by maybe 5 or even 10 basis points. Not a very big move, but enough to signal the markets that they want rates to go up. The Federal Reserve is looking at those employment numbers, looking to prevent inflation. We're going to talk more about the structure of inflation later, but it's important to note that a big component for the Fed is wage inflation. As much as we're seeing job growth, we're not seeing wages rise very much right now, and that's keeping the Fed on a razor's edge of trying to balance economic growth against inflationary pressure. We'll keep you posted on that as the Fed goes. And then finally, I wanted to talk to you about the U.S. trade gap. In the month of July, it expanded by about 7%. Most people don't really know what the trade gap does. But let's assume for a moment a country imports $1 billion of goods and it exports $100 million of goods. Well, they would have a $900 million trade gap. And what that in effect does is transfers $900 million from the buying company into the exporting company. In other words, it transfers your wealth. When the U.S. has trade deficits like we do with China and other countries, what we're doing is transporting our wealth into those countries. Now, to some extent, it can be healthy, believe it or not, because it creates a demand cycle in those other countries. But too much of a trade deficit, well, that can be devastating, and we're going to talk about that again as we talk about inflation tonight. But again, bringing this down from the geopolitical to the economic to the financial, I'll call that the 10,000-foot view. Couple things that are of high importance. Last week, for the first time in a long time, we saw all 5 days be very negative for the Dow, the NASDAQ, and the S&P. In fact, it was almost, in the last 12 months, I think the only time it's done that, 5 straight days. This was driven by several things. Number one is the potential interest rate hike. Number two is a continuing slowing economy in China. And number three is this dismal U.S. economy. Yes, we're growing, but a 2 to 2.5% growth rate doesn't make the markets very happy. In fact, Jim Cramer, who many of you watch when he does his hedge fund show, actually came out, and I want to quote this right for you. He said, "It's time to raise cash. The market is falling like a knife." Now, I think Mr. Cramer's wrong here. In fact, we saw it rebound a little bit this week. The fact of the matter is, though, as you and I have talked, the markets are skittish. They're scared. And that's why we're introducing the Market Crash Portfolio for you. We'll talk about that more in just a moment. The final thing in the financial arena that I thought you should be aware of is that gold, that inflation hedge that at one time was at $1,600 an ounce, well, so much for inflation, at least as measured by gold. Barron's had an article claiming that gold could trade as low as $800 an ounce anytime soon. The fact of the matter is, in the U.S. economy right now and in much of the world, we're less concerned about inflation than we are deflation. And that's a scary concept in economics. Again, one that we're going to talk about later in the program. So I've taken you from the 30,000 foot of the geopolitical world to the 20,000 foot of the economic world to the 10,000 foot view of the financial world. The important part where you come down to rubber meeting the road is what you do with your money. Well, as trying to help you and improve the program, we are introducing to you a little cameo appearance by our colleague, Jeff Garbaz. Jeff runs Superstock Investor, Quantitative Partners, and a number of other stock selection services, and he's joining the Master of Money to give you every week a new thing called the Market Crash Portfolio. This is a fully hedged portfolio with a great track record, and each week Jeff will update you on what that indicator is doing. So we're going to join Jeff right now for the Market Crash Portfolio moment.
This is Jeff Garbaz, and today I'm weighing in on the market crash indicators. Market crash indicators is going to become a part of the Rubber Meets the Road on a weekly basis, and we'll be analyzing markets so that we can hopefully help you avoid getting stuck in a crash. The genesis of market crash indicators came from a report we used to do called the Madison Letter, which is a process that I developed with two of my friends who used to be in the hedge fund business, where we looked from a standard deviation point to determine when markets were at extremes. So when we hit plus 20, we knew that we were a little overbought, and when we hit minus 20, we were oversold. And this was first doing it on a daily basis, but then we began to expand it to look at it on a monthly basis. And over time, it's done a really good job. Just to give you an example, it has picked up since we started doing it back in 2007, 18 winning signals to 8 losing signals. And the goal was originally to go buy, sell, cash, buy, sell, but then we added in cash as a component to it, and that's been a nice addition to the process. But the net is, it's worked out really well. The Madison Market Timing Index for the Madison Letter is up 79.18% through yesterday's close, which would be the 11th of August, 2015. And the S&P returned 46.68. So the outperformance is 32.50%. What's interesting is we have yet to pick up a sell signal since 2008. We got a bunch of them in 07 and 08, but we have so far whistled past the graveyard on that. And the current buy has been our longest buy on record, which we went to in February of 2014. So the Madison Letter is one component of the overall process. What I decided to do with market crash indicators, which we started in January of 2011, was to put in multiple indicators and arrive at an overall conclusion. Kind of the thought is, instead of just one process, we would add in multiple processes. So the second thing that I look at comes out of Phil Erlanger chart room, and that is called the Erlanger Big Barf indicator. What the Big Barf does, it looks at the relationship between the VIX and the S&P 100, and we look at it on a daily, weekly, and on a monthly basis. So as an example right now, the daily and weekly are in sell signals, and the monthly is still in a buy. The monthly has not dipped below zero since 2011. So we've had a pretty good time period here. The next thing is a model I developed, which is a 10-day moving average of the advanced decline line. And it's done a good job, reasonable job. It's a little more short-term in nature, which is why it fits perfectly into this process. It's returned 127.80%. Currently, it's in cash, and the S&P has returned 199 during that time period. So it's underperformed the S&P, but it's made us some nice money over time, and it's produced about the same number of winning to losing signals, 43 winning to 44 winners. But overall, it's done a nice job. The next component comes from Steve Simon. He is a great research guy I work with out of Chicago, used to be on the floor of the CBOE, and does really unique price and volume work. And specifically, he has an indicator called the Greed and Fear Index. We want to be looking to buy when fear overwhelms, and when greed gets too high, we'll be looking to sell. So currently, Steve's at 29. Once we're below 30, then we kind of know we're coming towards a fear point, and the market should hopefully start to rally. So it's been a nice addition to the model. Next, I also look at another indicator that myself and my partner, Jack Barenberg, developed, which is a slope of the 50-day moving average. What we found is not being above or below the 50-day moving average is as important as what the slope or the direction of the 50-day moving average is. And unfortunately, right now, we are in a downtrend and in a void on the slope of the 50-day moving average. So as you can see, we've got a lot of kind of mixed signals here so far. Next, we look at high beta versus low beta, and we measure that through two ETFs that S&P created for I believe iShares, and actually, excuse me, it's for Power Shares, and one is SPHB and one is SPLB. And so right now we are overweight low beta. So we're in a situation where high beta is not working as well. The next component is looking at the Russell against the S&P 500. So a small cap beating large cap, which is not happening right now. And last, we've developed a unique indicator on the VIX, which is a proprietary indicator, but it looks at implied volatility over a variety of time periods. And right now, that's telling us that we're overdone on the downside. So out of this, each week, we come up with a unique process that tells us, and you, the reader, how much to be invested. We're either 100% invested. In that case, we own SSO, which is 2 times the return on the S&P 500. It's an ETF that exists. If we're 75% invested, we're in SPY. If we're 50% invested, we're in the S&P Power Shares Downside Hedge, which is PHDG. Cash is cash. Cash, we're on the sidelines in money market funds. And if we go 100% short, which is pretty rare, but we have done it about 13 weeks so far in the process, we would be in SDS, which is an inverse ultra short, which gives us 2 times the return of the S&P. That we would have pretty tight parameters on. And so the question that you should ask is, well, how's this model done, Jeff? Over time, it's done a great job. It's returned 52.22%, and the same period, the S&P is up 38.99%. So that's nice outperformance. And since we started adding in the ETF component, the ETFs have done a good job. We've participated a good amount of the upside, not 100% transparency. Looking at it right now, our return is 19.51 through yesterday against the S&P's return of 36. But remember, it gives you ease, and you don't have to worry about things. What's interesting is, in this last update, the S&P lost 1.23. We're 75% invested right now, and SPY lost 87 basis points. There's some weeks where you can get these type of anomalies between the return of the S&P 500 and SPY. So that is a quick summary for everyone of the market crash indicators, which is going to become an integral part of Rubber Meets the Road. And going forward on a weekly basis, we will be talking in particulars about things that we are seeing and what our strategy is. So for right now, we remain 75% invested. We're still in a very narrow trading range, 25% cash. China is a concern to us, but we think that a bottom is coming pretty soon, and it would not make sense to be 50% cash or to be in cash right now. That's it for now. Hope you have a good rest of the week, and markets return to some strength to the upside.
Welcome back. I certainly hope that you enjoyed that segment from Jeff, as it gives you something tangible to do with the information we provide. I want to mention also, as part of our revamping the Master of Money, we're in the process of launching a new newsletter. That newsletter, entitled Rubber Meets the Road, appropriately, will be launched later this month. And if you'd like to learn more about it, I welcome you to write me at steve@stevebeaman.com. Rubber Meets the Road will give you every month the insights you need into the geopolitical, economic, and financial markets and news, but also give you this implementable market crash portfolio. We hope you'll take advantage of a unique offer that we have coming out, and we'll certainly let you know more on that in future programs. So stay tuned for that. Now tonight, as I indicated, I want to talk with you about something that's often misunderstood, and it's used by fearmongers out there to take your money in good stead. A lot of people got suckered into some of this. Yeah, we're going to talk about inflation and deflation and what causes them. It's important because especially people who watch late night television have for a long time been told, buy gold and run for the hills. Well, if you did that, it wasn't very long ago, gold was at $1,800 an ounce. And it's dropping now, at least according to the Barron's article, possibly as low as $800. So you want to be careful that you're not overly exposed to these volatile commodities. But let's take a look and try to eliminate some of the myths that are flying around of inflation and some of these myths that the perma bears use to scare you out of your money. Are we going to end up in a world with $1 million loaves of bread like they did in Weimar, Germany? I don't think so, and I'm going to show you now why not. If we look at inflation and think of core inflation as a function of productive capacity versus utilization. In other words, if you've got a factory and it can produce 100 widgets a month, you don't really get inflationary pressure until the market is demanding more than 100 widgets a month. At that point, the manufacturer says, I'm going to raise prices to squelch demand. Well, that's the most basic cause of inflation, is that manufacturing capacity can't keep up with demand. Well, in the United States today, we're running manufacturing capacity at about 70%. We're nowhere near the point at which manufacturers have to raise prices to overcome that demand curve. Well, that's the bottom line, and that is the core cause of it. If you look right now, for example, at the Federal Reserve and why you hear all the economists saying we have no inflation, that's why. Because our capacity to produce more still exists, and very, very strongly. Now, the reason that's important and where the rubber does meet the road on that issue, if you receive Social Security or you're looking at planning a retirement and looking therefore at Social Security as part of it, well, the cost of living increases on Social Security are set by the inflation rates as measured by the Federal Reserve. Well, when they see no inflation in the underlying economy, you don't get a cost of living increase. Well, that can be painful for those of you if we have spikes in things like food and fuel. And let me touch on that for a minute. I have a lot of people who say to me, you know, Steve, you say there's no inflation, but look at food and fuel prices. Well, these are highly volatile commodities, and in fuel, we did have inflation a few years ago. We went on a global level from about $60 a barrel up to $100 a barrel. That caused prices to rise in transportation and food. But guess what? Over the last couple of years, because of increased capacity, especially in fracking, we've seen oil come from $100 a barrel down to $50 a barrel. Well, that's caused those food prices to come down. You just don't hear people talk about that often. So as you look at these commodities that fluctuate wildly, it really isn't a good idea to look at that as inflation. But I want to talk about a corollary to that, which I hear all the time. People tell me that we're experiencing a monetary inflation because of a devaluing of the dollar. Well, that's a scary thought when you have it, and that's what caused the Weimar Germany to go 1 billion Reichsmarks for a loaf of bread. Well, are we going to have a devalued currency which leads us to massive inflation? All right, let me talk about that with you for a minute. And this is important to understand. If we look right now at currency values, in fact, I announced earlier that China just lowered its currency values. They devalued their currency. What that does is affect your trading partners. And as your economy is more and more dependent on trading for its economy, a change in currency values can be very impactful on your economy. Well, let's look at the United States for a minute. When I talk to people about trade, most people think we're driven by China. Well, that's just not true. The net trade that we do in and out of this country is about 3% of our total economy. We buy imports of about 1.6 billion, and we have exports of about 600 billion. So the fact of the matter is our international trading is not the driver to the U.S. economy. So trading in currencies doesn't really affect our prices all that much. Yes, when China devalues its currency relative to the dollar, it's cheaper to buy from China. So at the margin, we'll see a little more importing from China and a little less exporting from the United States, but not enough to cause a crippling hit to our economy. We don't have a situation like Venezuela. We don't have a situation like Russia, where they are dependent on other countries for their very economy. We are self-sufficient, and that's why the United States isn't subject to a crash of its currency like that. Let's talk about debt, because that's the other dimension that people get into. When we talk about a monetary crash, people say, well, look at our $18 trillion in debt. Well, look, I'm the first one to tell you that I've preached for years that debt must be settled. I don't like that much debt. But when you look at it structurally, the fact is we owe ourselves the money. What the United States has done is borrowed from its savings account to support its checking account. Now, at some point, that's not smart, but it's not devastating. If you look at the cause behind, again, the Weimar Germany situation, they owed other countries the money. If we look at Venezuela today or these other tin pot republics, they owe other countries the money. Well, the United States doesn't owe anybody else the money. We owe ourselves. And so what our debt will do is not collapse and cause a collapse of the dollar. It will shave points off our growth. Today, we're growing at about 2.2% a year as an economy. If we didn't have all the debt we have, well, we'd probably be growing at 3.2%. So it does affect us, but it affects us by shrinking the growth rate. It's common sense. Look at our student loan debt right now of $1 trillion. What does that do to students coming out of college? Well, what they do is use their cash flow to pay back debt rather than participating in a consumer economy. So it slows growth down. But it's not going to lead to a collapse. And as proof of that, look at gold. Historically, a very good bellwether of inflation. Is gold signaling a rise in inflation? No, quite the contrary. It's looking at deflation. And let's talk about that for a minute, because if we're not going to have inflation, should we and are we concerned with deflation? Well, here's what happens in deflation. Prices go down increasing amounts. And what that does is stagnate an economy. That's the cause of the 1929-30 depression. Prices, after the crash of the market and that wealth evaporated, prices began to come down precipitously. Well, you're a buyer. If you know you can go to the store in a month and pay less than you paid today, you're going to hold off your buying. Well, that's exactly what happens in deflation, which is why it puts economies real quickly into very ugly recessions. That is what the Fed has been trying to avoid with its stimulus programs, and that's what the Chinese government has been trying to avoid with their stimulus programs. We don't want to see deflation in our economy. That will take us into negative growth rates. What we want is mild inflation. In other words, an incentive for consumers to buy, but not at a level that you lose lifestyle like we had in the 70s. All indicators right now are we're nowhere near inflation like the 70s. In fact, we'll see it moderate here. And that's why the Fed is looking at maybe just tweaking up those interest rates by 25 or even 50 basis points. These are terribly small increases and they won't do anything. But it does begin to put a world of savings back into the mirror or into the light so that savers get some reward versus spenders. And that's what we want to see as well. So as we look at inflation and deflation for your portfolio and your income, truly where the rubber meets the road, I would suggest you right now don't panic over inflation and don't buy into the fear mongers who tell you that run for the hills, bread's going to cost $1 million a loaf. No, it's more likely we're going to suffer from a bit of the other, the deflation, and that's going to hurt everybody. But let's keep an eye on it as the Fed continues to try to stimulate and keep us out of those problems. We'll see if they're successful. Bernanke certainly learned from the 1929 depression, which is why we didn't have one after the 2008 debacle. But we'll have to see exactly where all that leads. So with that said, and I've preached about debt must be settled, I believe it to be true, but we've talked a little bit about the real impact, that it'll just slow growth down. It will make equities more attractive as interest rates are so low. That's why the markets are so high. But as those rates come up, well, guess what? Equities will come down. And that is why we released the Market Crash Portfolio to you. Something you can do with the insights here at the Master of Money, and something that you can do to build that more prosperous wealth that we're all out for. Well, that's our show for tonight. As always, I want to thank our sponsors, Harvest Investment Services. I also want to thank the Society to Advance Financial Education for its support. We hope that you'll support the Society as a not-for-profit enterprise organized simply to provide financial education across this country. I also want to thank Jeff Garbaz for his participation by providing us the market crash portfolio. We look forward to having him on our program going forward to give us more and more insights. As always, if you have questions, you can reach me through my personal email at steve@stevebeaman.com right anytime. I get an awful lot of emails, so I can't guarantee I'll write you back that day, but I will get to it at some point. So until next week, have a happy and prosperous and healthy week. And when you're making decisions, make sure you avoid that shiny object in the corner and make a decision where the rubber meets the road for you.